All right, let's just get right into it. We're living in this wild time of meme stocks, cryptomanias, and just constant hype from the financial news. And it's created a ton of confusion, right? The line between making a smart, calculated move and just, throwing a dart at a board has gotten seriously blurry. It really makes you step back and ask a big question. Are you actually investing or are you just speculating? So let's just put it out there plain and simple. When you click that buy button on a stock, are you truly investing or are you gambling? It's a huge distinction because according to the guy who literally invented value investing, Benjamin Graham, the absolute fastest way to lose your shirt is to speculate while thinking you're investing. At the end of the day, the difference really just boils down to your mindset. Speculation? That's all about betting on which way the price will wiggle. It's totally emotional, it's about chasing whatever's hot, and it's obsessed with the short term. Investment, on the other hand, is, well, it's businesslike. It's about looking at the company itself, doing real analysis, and making sure your money is safe for the long haul. Now, to really get a handle on this, we need a guide. And honestly, there is no one better to turn to than the man who literally wrote the book on the subject, Benjamin Graham. This guy is known as the father of value investing. He is the one who created security analysis as we know it, and he was the mentor to legends. I'm talking about guys like Warren Buffett. His books, Security Analysis and The Intelligent Investor, they're basically the Bibles of Wall Street for anyone who wants a disciplined, rational way to think about the market. And look, this wasn't just some academic theory he came up with. The proof is in the pudding. The numbers don't lie. For 20 years straight, from 1936 to 1956, Graham's investment firm delivered average annual returns of around 20%. The market average, just over 12. His principles worked, and they worked really, really well. So you've got to ask, what was his secret? How did he do it? Well, Graham had this incredible ability to cut through all the noise with a single, simple definition that becomes the framework for everything else. And here it is. This is Graham's golden rule. It's super precise and there's no wiggle room. An investment has to promise two things. First, the safety of your original money, and second, an adequate or satisfactory return. And it all has to be based on thorough analysis. Anything, and he means anything, that doesn't check all three of those boxes is, by his definition, pure speculation, period. Let's break that down, because these are basically the three pillars of investing. First, thorough analysis. That just means you do your homework. You understand the business like you were going to buy the whole company, not just a few shares. Second, safety of principle. You're actively trying to protect yourself from taking a big loss. And third, adequate return. You're looking for a reasonable profit. You're not trying to hit a home run on every swing. If even one of these pillars is shaky, guess what? You're not investing anymore. You've wandered over into speculation territory. Graham had this great analogy for it. When you go grocery shopping, what do? You check the prices, you look at the quality, you're focused on getting good value for your money. But when you buy perfume, you're paying for the fancy bottle, the brand, the feeling. An investor is always, always the grocery shopper, asking, what am I actually getting for the price I'm paying? Now, to help people stay in that rational, business-like frame of mind, Graham came up with this amazing little story, this mental tool to help you deal with the crazy psychology of the market. So let me introduce you to a guy named Mr. Market. Okay, so here's the deal. Imagine you own a piece of a business, and Mr. Market is your partner. Every single day, he shows up at your door and names a price. He's totally willing to either buy your shares from you or sell you more of his, at whatever price he quotes that day. There's just one tiny problem. Mr. Market is a complete manic depressive. Yeah, his mood swings from one wild extreme to the other. Some days, he's totally euphoric. He only sees good news, overlooks every problem, and he'll offer you ridiculously high prices for your shares. But on other days, he's in a deep, dark depression. He's terrified, obsessed with everything that could go wrong, and he'll offer to sell you his shares for dirt cheap prices. The most important thing to remember is that his price is based on his mood, not the actual value of the business. And here's where it gets good. Here's the secret. You hold all the cards. You never, ever have to trade with him. You can just shut the door and ignore his silly offers. See, the intelligent investor doesn't get sucked into his drama. Instead, you use his emotional foolishness to your advantage. You happily sell to him when he's ecstatic, and you eagerly buy from him when he's panicking. That idea, being able to buy from a panicked Mr. Market, it leads us right to Graham's single most important concept for protecting yourself from risk. He managed to boil down the entire secret of sound investing into just 3 words: margin of safety. And you can really see how much his most famous student, Warren Buffett, took this to heart.
I mean, Buffett's two famous rules are really just another way of saying how unbelievably important that margin of safety is. It's all about avoiding losses.
So what is it exactly? It's simple, really. You do your analysis to figure out what a business is actually worth, its intrinsic value. The margin of safety is the big discount you demand from that price. It's about buying $1 worth of a business for, say, 50 or 60 cents. That gap, that is your protection. It's your buffer against bad luck, mistakes in your own judgment, or just a crazy market. It is your ultimate defense. So what happens when you ignore this? Well, just take a look at the data on IPOs, initial public offerings. For over 2 decades, if you bought into the hype of every new company going public, which are often priced with absolutely zero margin of safety, and just held on, you would have underperformed the market by a shocking 23% per year. That's the price you pay for speculation. And all of this brings us to what might be Graham's most profound lesson of all. Because after you've done the analysis and after you've understood all the principles, real success comes down to mastering the one and only thing you truly have control over, yourself. It's probably one of his most famous lines, and for good reason. We spend all this time analyzing companies and charts, but Graham insisted that the real fight is internal. Our own emotions, our greed when things are going up, our fear when things are going down, are way more dangerous to our financial health than any market crash could ever be. And that's the big mental shift you have to make. You're not trying to outsmart everyone on Wall Street. You're just trying to control your own worst impulses. True success comes from having the discipline and the courage to stick to your rational plan and to just refuse to let Mr. Market's moods dictate your decisions. I mean, this really says it all, doesn't it? This is the ultimate takeaway. You could be a genius at picking the best businesses in the world, but if you freak out and sell at the bottom, or you get greedy and chase things at the very top, none of your brilliant analysis matters. In the end, your behavior is what drives your results. So as we wrap up here, I want you to ask yourself this one question and be really honest about it. When you look at your portfolio, what do you see? Do you see a collection of ownership stakes in actual businesses that you understand? Or do you see a collection of lottery tickets, just a bunch of bets on prices going up? The answer to that question makes all the difference in the world.